Hi, everybody. Welcome back to another edition of VC TV. I'm your host, Kyle Ellicott, and we're going to be talking about private equity today. What is happening in the private equity space that you as investors need to be aware of in terms of trends, opportunities, industries, things in general. But entrepreneurs, what does private equity mean to you? How can you use it in your fundraising effort? How can you use it in your M&A efforts as well? We're going to talk a little bit about that today as I'm joined by outstanding co-hosts from around the world. And we're going to jump right in. But before we do, big thank you to the LATOKEN team and to Maria for making today's episode possible. With that, Keith, welcome back to the show. First intro and background for everybody.
Hey guys. So after 20 years in venture, in the last year, I've moved over more to the private equity side of things. I began, after a career as an entrepreneur through the 1990s, I was headhunted into Mitsubishi Corporation to start up and run their Canadian venture capital activities, then became president of BASF Venture Capital America, opening up their office in Silicon Valley, and then 10 years as general partner of Pangea Ventures, raising and running funds 3 and 4. In 2020, after helping a friend reposition his display materials company as a market expansion story rather than a tech story, which led to a very quick acquisition by Lenovo, we began thinking, there are a lot of companies that have really good products or services, and yet they lack vision and ambition, and they're kind of stuck in whatever their vision of the market is. Could we not acquire those companies and then help them go out after their true market opportunity? And that's how UpperStage was born, and how I've made the transition into private equity.
Wonderful, and excited to hear more about the PE space as well. It's not talked about much in the entrepreneurial startup world until you get to that M&A process as well. So learning a little bit more of what you've done and others is going to be exciting. Giampaolo, welcome to the show as well. A little intro, a little background.
Thank you very much, Kyle. Thank you for having me. This is Giampaolo Parigi. I'm a serial entrepreneur and investor with 30 years experience on international marketplaces in 5 continents. I've been a VC, I've been a private equity, still am a private equity specialist and a VC, and an investment banker. At the end of the day, there's a lot of semantics behind all of this, and I would like to address also, with the help of my egregious fellow partners here on this panel, why our viewers should be informed about the distinctions that might exist between one category and the next one, because especially companies that are out there raising funding may equivocate on the roles that each of these broad categories in their silos have in the 21st century. And I'd be very happy to, clarify some of the potential misunderstandings and pitfalls for those who are looking for capital, and in general for entrepreneurs out there. Thank you. Back to you, Kyle.
Thank you very much, Giampaolo. I was going to start with Keith. I think I'm going to come to start with you. I think you've just painted a very good starting stage. So Keith, I apologize. I'm going to start with Giampaolo. I know. Sad face. It's okay. Well, I'll make up for it. Don't worry. Adrian, welcome back to the show. It's a pleasure. A little intro, a little background for everybody. Oh, looks like we may have lost you, Adrian. We'll come back to you here in just a minute.
Hello, everybody. Thank you very much.
Go ahead, Adrian. All right, we're going to hold on Adrian there for just a moment. Dr. Srikant, welcome back to the show as well. It's always a pleasure. Hope you are doing well. If you can, a little intro, a little background, please.
So just a quick thing for everybody at the panel and everybody who is hearing this. I just recovered from my second COVID. 6 months back, I got the first COVID, and I got the second COVID about 15-20 days back. So I'm Dr. Srikant Parthasarathy, a legal advisor by profession, but I also happen to be a counsel for the Forbes 500. So as a counsel, you also encounter a lot of family offices who want to evaluate certain investments, and private equity deals is one of the essential elements, I would say, that that makes up about what 70% of the deal size or the deal market at the moment in India at least. And having worked my way up the Citibank ladder and being a Citibanker, I'm going to give you a perspective as to how the family offices, which is the other side, sees private equity as an option. So I was instrumental in the acquisition of a particular biscuits company quite recently, and this would be in the news and so on and so forth.
Well, first and foremost, thank you for joining us, and glad to see you recovered as well. We love having you here on VCTV, but if you need to step away at any moment, don't hesitate, please. And also excited to hear more about this biscuit company. It's got me a little hungry all of a sudden, so I'm excited to hear more about that. But Adrian, if you're back with us, a little intro, a little background, please. Okay, I think we lost Adrian there. Giampaolo, let's kick it off. Talk to us a little bit about some of the misconceptions and opportunities when it comes to PE and how that plays a role into the startup ecosystem for founders and entrepreneurs that are out there.
Yes, well, I think we gotta really abandon the notion, the 21st century notion of what the capital markets used to be up to even only 20 years ago, because it has definitely evolved into a full-blown 21st century type of operations overall as a category. And certain events, COVID for sure, has impressed an even greater acceleration to how the markets are transformed. I'm talking about financial markets. Let's zoom back a moment. Rewind. Last century, till the end of last century, we used to define those two broad systems, the banking system, the financial markets, and the risk investors group, the so-called capital markets. And pretty much things have been stable and remain stable for decades, although with some modifications. But we cannot go too much in details here. There were already, let's say, activities in the magmatic chambers of the volcano, but they were not visible yet. Definitely in the 21st century, what's happened is that this market has been dramatically changed, and we, as the general public, I think also many of our viewers have remained anchored to the definition that we used to utilize back then. And now fast forward to the 21st century, what do we see? We see these four categories. The banks are really doing a lot of things, banks used to do, but the banks are taken in a quandary because of the digital transformation, and some are trying to reposition, realign, some are going belly up and have to be amalgamated and absorbed by other banks because of the failure of their business model. Some have successfully transitioned towards digital, but the banks overall as a component in the market that is providing liquidity to companies is shrinking, and it has shrunk dramatically over even the last 10 years, and it's supposed to continue on that direction with this trend. When we move to what we used to call the capital market, so the broad expanse of risk investors, we have something which is radically different from what we have seen in the 20th century, because venture capital firms, I used to run for 10 years in Silicon Valley at venture capital firms, but most venture capital firms nowadays have become, especially the biggest one, have become asset managers of third-party money, more or less in disguise. It's not that they have anything to conceal by doing that. It's just a fact. It's just an element of the state of things, and there's nothing, I would say, inherently positive or negative in things being so. They just are like this. But because of the new posture that venture capital firms, by and large, have assumed, a lot of them are not choosing to do anymore the type of job that they were doing 20, 30 years back. And the entrepreneurs, and anyway, people that have interest at stake and that need to interface themselves for the purposes of raising capital with venture capital firms, sometimes are having, because of a miscarriage in communication, very hazardous results when it comes to, successfully raising. Most of them are, investing a lot of time, some resources, and they do not obtain anything simply because they are barking at the wrong tree, because what they thought that was the tree that they needed to bark at, in the meantime, has been substituted by another tree. Private equity used to be the category of single-family offices, for example. I mean, I'm a chairman of a single-family office in New York. We do invest, and we normally invest in the forms of, GP or quasi-GP style with direct investments without even the activities of the fund. And other times we may take a position as LPs. Single-family offices, have normally these two variations, but they are more and more going for direct investments outside of the boundaries of investment funds. Private equity funds have become really, again, fund managers more than equity investors that they used to be. I mean, they still invest in equity, but the way they do it is mediated through the use of the fund. Now, a viewer might ask, okay, how does that affect me as an entrepreneur? Well, it does affect you, because if you think that about 80% of the private equity firms out there in the market belong to banks, you begin to see backstage what's going on, and the fund managers that are under the influence of banks, even if it's at arm's length, have a different posture than the typical mainstream private equity that people may think about of back in the days, when you had, risk investors ready to deploy capital very quickly, very efficiently. And now, with the fact that those private equity firms and funds are belonging to banks, we have witnessed an increase in the layers in the sandwiches, and the length of time that it takes and the amount of procedures that are required for a private equity fund to complete the transactions have become cumbersome compared to what they used to be even only 20 years ago. And one might argue, oh yes, but this is because compliance has increased. Sure, but that's not all the reason. Part of the reason is that the owners have been changed, the policies have been modified, the posture on the market has been altered, and as a result, what we still keep calling as private equity fund, having in our brain and in our mind the idea of a very fast investor and quick investor with really risk capital, has been changed. Now, the role of private equity funds in general has been taken for this velocity that people are still associating with the private equity fund, has been taken primarily by single-family offices and sometimes by multifamily offices, because those are the actors that are, more prone to invest quickly and faster. A typical investment fund would take anything from 45 to 60 days for a due diligence, and that's just for starters. And then there would be the negotiations, and you can get into a conduit that may last well into the, more than a half a year, and then you end up with a no, thank you, but we're not going to invest in you, and you wasted 6-7 months, maybe on an exclusivity basis, and then you got to start back from square one and go through the whole ordeal again with, the imaginable amount of costs and the frustration that entails. Lenders, there's a number of alternative lenders, and I put the last element in the picture, that now are coming to the market because of the, I would say, either implicit or explicit failure from the banking system to take care of a part of the market. And so more and more alternative lenders are coming out. And I'm talking about licenses and regulated players, not just those joker brokers or wannabes that are populating the internet with all sorts of crazy proposals that unfortunately some of us as incurred into, and those are pitfalls. So I'd be warning everyone to really do the due diligence very carefully on the interlocutors that they are engaging on and with when it comes to financial matters. And again, this is not financial advice. This is for educational purposes only, but please verify who you're dealing with. So I think, the market has been really dramatically altered. So especially startups are the ones that are suffering the most, because they have, the the least of the resources, the least of time to go around looking for capital, and they have the most of the need. If you compare, a startup needs with a middle market company needs, a middle market company may need more capital, but it can also survive longer while it searches for capital. If it takes a few months to maybe even a year, it wouldn't really impact the bottom line significantly unless the company is in a pre-chapter 7 or 11 state of affairs. So startups sometimes don't have the type of runway. Most of the times they don't have the type of runway, and they don't even have a structure that can be redefined quickly, because they all come out with this cookie cutter business, which is all 20th century style, and it need to be changed. I'm doing an effort. I created a technology amalgamator in the European Union, which is open to technology companies from all over the world, startups, of course, that is really working towards the redesigning of their models, because investors are sick and tired of seeing just the usual pitch deck and hearing the same pitch all day long. We need to see exactly what a company can do for the audience that it wants to address, be it B2B or being B2C. So as I'm trying to tell you that, we cannot describe with a single figure what is happening in the market. We would need what we call a vector in geometry, because those are transformational processes that are coming across the whole bandwidth of the financial world and are affecting how players reshape, it's evolution of the species. Maybe if we want to go by an analogy with nature. And I'm sure that, because I see it every day, that the markets on the business side and the corporate side are not yet really prepared to fathom how things are changing. Not even to take into consideration also everything else that has been brought about by the new compliance standards. So it's a topic that once you unpack it, it's really like opening a Pandora box. But I think I've taken now enough of the time, and I would like to hear my fellow colleagues what they think about this and how we can address it so that we can help startups achieving their goals. Thank you very much.
Thank you, Giampaolo. It was a great stage setting for us. And Keith, I want to come to you next. Anything to add, but also your take on private equity as this is how you formed UpperStage. So talk to us a little bit more about that.
Yeah, that was fascinating. But I have to say that my experience with private equity has been quite different. And that may be a geographical difference or whatnot. But let me start from the beginning. I don't think that private equity is a good match for startups. I think that private equity is a good match for the needs of businesses that have issues around succession, around investor fatigue, around a need for a change in ownership. And it may be to provide an exit for a retiring founder. Or there may be a number of reasons that drive this, but it's not really a startup. Private equity is investing in a business that is, generally speaking, already profitable. And certainly for mainstream private equity, you're talking about businesses that have revenues of 50 million and up, 50, 100, up even into the billions. The end of the market where we play is the lower end of the market before the mainstream PE firms get engaged. So we're really interested in that 5 to 25 million revenue range where they have 1 to 5 million in EBITDA. That's a really interesting, very underserved part of the market. And the reason why it's underserved is that most of these PE firms are, in my experience, not run by banks. That may be a European thing, but no, they do tend to be run by private equity fund managers. Yes, there are also active groups here in the family offices, but they're essentially run the same way. But most of the PE firms do tend to be quite a bit larger. And so in order to keep things manageable for them, they have to do larger transactions. And at the end of the market where we play, there's very few players. Because of that, the valuations are a lot lower. It's a supply and demand issue. When the supply of capital is very high and the demand for deals is very high, then the price will be higher. And at our end of the market, where the supply of capital is lesser and there's lesser demand for those deals, of course, they have to be priced lower in order to get their deals done. Simple economics. But it does provide for this beautiful arbitrage where we can get into a company at a very reasonable valuation, still provide a very good exit for departing founders or whatever the issue is, and then we grow the company, and we have a hands-on approach to doing that. We put an operating partner into the company to take them to to provide that vision and ambition that I talked earlier about that is often lacking in these companies. And grow them to the point where they become very interesting for mainstream PE or to any of the strategics that we've worked with before. So that's a simple model for how you get to a high multiple return. The other thing that really makes it very different from venture capital, there are actually many things, and I'd be happy to talk about them here, but I want to make sure everybody gets a chance to talk. But one of the major things that really makes things different here than venture capital is the use of debt. Leveraging the buyout is very common. When we first were putting together our first offer on a deal and I started to talk to banks to explore this topic, I was shocked by how eager the major banks were to say, oh, yeah, we love that kind of business. Oh, let's see the numbers. Oh, it's profitable. Oh, that's great. Look at that EBITDA. Yeah, we would support it with a large amount of the capital to get in, like 3.5 times the EBITDA. And on some of the smaller deals that are maybe a little bit distressed, you may be only paying 3.5 times EBITDA to buy them. Companies that are pretty healthy in our range, tend to get that 5 to 6 times EBITDA range. So you can still get 50% or more coverage from the debt side of thing, which is easily managed out of the company's EBITDA. That's very different than venture capital. I mean, it's almost like having low cost, non-dilutive, although there's some cost, but non-dilutive matching funding available for you for every deal. It's incredible. So I've definitely been enjoying working with the support of low cost debt.
Thank you, Keith. Dr. Srikant, coming to you, anything else to add to Giampaolo, Keith, but also your experience working in PE and being based in India, but just generally throughout Southeast Asia, some of the work that you've done?
So I think we have got a polarized view in terms of the use of private equity as a means of capital. So as far as I have seen, in terms of so I've closed a few term, not a few, quite a few term sheets, and the trend that I've been seeing is there is the amount that the family offices typically set aside for a particular deal is not different from what it was pre-COVID. So if I have to slice it and dice it from a timeline perspective, I don't see any difference as such. But let's look at it holistically. Who are these private equity players? These private equity players are basically players who are mandated to do certain, or who are mandated to perform and execute certain returns for their investors. So which would be family offices, which would be again venture capitalists, and so on and so forth. So I agree to certain points in terms of saying that there is a fixed multiple, there is a rigidity which exists in the private equity market, but you would be surprised by the class of assets that are coming up post-COVID, because what was, for example, I mean, let me go to the example that I was referring to, which was a biscuit business. This biscuit business pre-COVID was valued at possibly 10 times the price of acquisition that we acquired recently. but we had we got it at 1/10, and private equity basically survives in this particular, or thrives in this particular phenomenon, isn't it? So I would take a divergent view, or rather a balanced view, that in India we have typically seen. I mean, the private equity deals used to be in upwards of about $100 million. Now the private equity deals are even closing at as less as about $5 million for a buyout. I'm not talking about a majority situation either. But what I have seen is it seems to be all in or all out. So they either want to go 100% and acquire, and then leverage it, or make it run for 2 years and then again sell it off to somebody else. Or the private equity players never seem to be interested in a minority stake. So I agree to the point which was being made, which was it is not for seed capital, it is not for early stage. It is quite in between, when you have raised your initial capital and then you want to make the quantum leap, and then you get in the private equity players. So you have a large pool of private equity players who are actually active in the market, and you have a large pool of venture capitalists too, who have a particular setup or a tie-up with a private equity player, that a venture capital company comes in for the first round of equity, and then a private equity comes in or follows through. For example, TPG does that, especially for large companies, for large acquisitions. So they breed the company, they let the company survive for 4 years, with the hopes that after 4 years I will acquire. So that is also a development that we're seeing. And even venture capitalists seem to be deploying as a GP myself. I used to deploy debt as an instrument when I was a GP. Now that I've become an LP, I see that also as a possibility from a venture capital perspective. So it's not limited to the private equity alone, that they leverage their buyouts, but debt itself as a form of equity is also coming in.
Thank you very much. And looking towards next steps. So as an entrepreneur, how do I start taking advantage? What advice do you have around PE as we come to close for today's panel? So your closing thoughts, and how as an entrepreneur, do you start to enter the world or take advantage of private equity? And then where can everyone find you to continue the conversation? Giampaolo, let's start with you.
Yes, well, I mean, I just want to give my own opinion, professional opinion on what I'm seeing in the market. When I started a single family office over 20 years ago, I had already close to more than 10 years in private equity. And I already knew by then, and I'm talking about year 2000, that the private equity industry as we know it today was going to die soon. Same for the venture capital industry. They are both decaying. Their survival will be visible still and for another few years. But overall, those two industries are dying. They are not fulfilling the role that the markets require them to fulfill. VCs, and as I say, let me generalize here, I'm not implying that anyone in particular is doing it. I'm saying what I see in a broad category term, VCs are chasing unicorns, and unicorns by definitions are hard to get by. Private equity firms are chasing middle market deals. Well, I could show you when I created a single family office, and I'd be more than happy to reconvene on another panel to illustrate what can be done. I decided to do the single family office to nosedive private equity to the level of greenfield startup investments. And it's possible to do it. I did it several times over, exiting, most of the time successfully. Sometimes, of course, the deal didn't go well, but not because I had done a different approach in policy. What I'm telling you by this is, and I'm closing with that actually there are several different ways to do things, and we should challenge conventional wisdom. In terms of entrepreneurs, I could say beware who you're dealing with, not in terms of, like I said before, in this case of the, I would say, legitimacy, but in terms of is the counterpart the potential best investor for me at this stage or not? And this is important because otherwise, it's going to be an enormous waste of resources, and who remains with the shortest straw is not the VCs or the PEs managers, is the entrepreneurs that has less of a runway than the people he's talking to or she's talking to. Why is it, and we see the trend in the market, why is it that more and more sophisticated LPs are going to single-family office for aligning, vision, strategies, missions, and investments, and sharing investments opportunities on a communal platform with people like them? Why more and more and more? Because when I say that the private equity industry is dominated by the banks, I wasn't referring only to Europe. I mean only in the United States and in Asia. When you take a look at the composition of the lineup of the LPs and see where the LPs come from, you would see that they are primarily coming from the banking world, and they are emanating.
People who have been migrated from the traditional banking industry to the private equity industry, investment industry, which is not, I think, overall a great signal of quality, because each different sector requires different trainings and skills and mindset. But I'll leave it with that, and thank you very much. I'm Giampaolo Parigi. You can find me on LinkedIn. Kyle and gentlemen and ladies, thank you all for being here.
Thank you very much, Giampaolo. Appreciate it. Keith, quick closing thoughts. Where can everyone find you?
Great. Well, you can follow me on LinkedIn or on Clubhouse, where I'm fairly active. I run a Canadian venture capital and private equity group every Monday at noon Eastern time. Every Wednesday, at noon Eastern time. Yeah, I mean, my closing thoughts are that my perception of the market may be, of course, I'm new to this from venture capital, and there has been quite an adjustment in terms of how deals are structured and things like that. It's generally familiar to me, but things in terms of process work very differently. I wouldn't say that this is a broken model at all. This type of capital is really needed. Going back to your original question, how can entrepreneurs take advantage of this? Entrepreneurs should really only seek this out if it is the right fit for them. If they have no clear path of succession and they are retiring, or if their existing shareholders are fatigued and need an exit, and don't want to support the company any longer, or they need some fresh kick to refocus them and move on to higher things, and they can't seem to get there on their own, then working with the right private equity partner can be a good fit. But it won't be a good fit for those pre-revenue or low-revenue companies. I'd be very interested to follow up with Giampaolo to find out about how he's been able to push down into the early stage of things. So maybe we'll follow up on offline. But generally speaking, the LPs that we have been talking to and the banks will only get behind our structures when there's positive EBITDA. So for those companies that do have that and do have good products, and customers are happy with what they're doing, and they need that refresh of the ownership, private equity can be a fantastic choice. On just to address timelines. My perception so far is that timelines to get deals done in private equity are not that different than venture capital. But of course, I do see the risk of pursuing one group in exclusivity and then the deal falling apart. But it's the same way there for venture capital when you are trying to get an exit, and you do sign up an exclusivity period with the potential acquirer, and then their due diligence something is not satisfied, or more likely that they have a change of strategy somewhere within their organization that causes them not to do the deal. That's the same kind of risk here. You can see us as the private equity as being the handoff, the next stage from the first or previous owners in a company. So this is an exit for them, and it runs those same kind of risks. But the timelines, in my experience here, are not that different. Some deals do take a long time, and it's usually because of issues on the company side, not on the investor side. And some deals move very quickly, and that's because things are well aligned between both groups. Yeah, so I'd be very happy to talk about this more, but I know we're running out of time, and we still have to hear from Dr. Srikant.
No worries, no worries. It's great. We'll connect everyone offline. Dr. Srikant, to you, quick closing thoughts. Where can you be found?
So, we are. I do not agree with the view that the private equity or the venture capital market is essentially dead. It is, the king is dead and long live the king. So we have seen the VCs as well as private equity players actually pivoting. So the private equity players are actually having a very good time in India at least, or in developing countries where the assets are actually cheaper than what they used to be, and they could flip it quite. I'm sorry for being so crass, but they could flip it quite easily in these markets. Insofar as venture capitalists are concerned, what they're doing is they are now they're trying to bring all the entrepreneurs in-house, and they are trying to create an ecosystem where the entrepreneurs can survive and then pivot along with them. So they are learning alongside the entrepreneurs. This is something that I'm seeing in India at least. I'm yet to explore the Israel market, which used to be very promising for the fintech as such, but that is for another session. I know my name is quite long to actually search, but a quick, I'm the only Dr. Srikant Parthasarathy who is a legal counsel out there. So keep that in mind when you search.
Wonderful. Thank you all very much for your time and insights today on private equity and where things are going, and also just in general how to think about it as well. Really appreciate it. To our audience, thank you so much for tuning in. If you like what you heard, click subscribe, share, and also like today's episode as well. And make sure to check out the archive on LATOKEN.com to hear from today's speakers and all speakers of the VCTV family from around the world. And please do reach out to each and every one of us. We'd love to hear from you. But as we always say, make sure to add context where you heard us, where you met us, and what you would like to continue the conversation about, so it is a prosperous conversation for all around. With that, I'm your host, Kyle Ellicott. Again, thank you to the LATOKEN team and to Maria for making today's episode possible. And thank you to all of you, Keith, Dr. Srikant, and Giampaolo, for joining us today. With that, everyone have a great day. We'll see you back here in a little bit with more VCTV. Bye.
Cheers.
Cheers.